a week ago, though, NVIDIA debuted or mentioned a new AI physical chip, right? So, I mean, there's a race there. Will they be a potential winner there, or will it be Tesla? Because all I hear about is Optimus is going to be a grand slam.
We think they're both going to be winners in different respects. I mean, with NVIDIA, the opportunity for physical AI is actually threefold. Not only is there silicon actually on the robot, you have the data center next to the factory, essentially training these robots, as well as digital twin infrastructure. So we could actually think that physical AI is the biggest opportunity of all the waves of adoption for NVIDIA, larger than enterprise AI, larger than the cloud wave that's going on right now.
Okay, let's talk about this networking demand, because you say networking is the new battlefield. What does that mean?
So the unit of compute is no longer the chip. NVIDIA's latest chip is 72 GPUs or AI chips linked together to act as one GPU. And these chips are approaching clusters of 1 million in a data center. So the real moat at scale is actually the interconnect. It's almost as important as the raw compute. And so this is where the battlefield is. We don't think it gets enough attention. NVIDIA's data center business, the networking component of that is now the fastest growing component, as we saw from their earnings results next week. But they're up against competition from some of the open standard players, so the Broadcoms, Amphenol's, Credos, A-Labs of this world.
Broadcom, obviously, it's a $1 trillion company. It still gets very little press. I think they report this week. And so is it like the sleeper name? It feels like in the $1 trillion club, it's the one no one talks about.
We think Broadcom definitely deserves more airtime, because not only are they the leader in Ethernet networking, they're present in 7 of 8 of the largest training clusters in the world, but they're also the leader in custom ASICs. So they're helping these hyperscalers develop their own chips for them. So as these clusters of AI chips scale in data center, they actually get a double benefit, and we don't think that's priced into shares.
Amphenol, I think, is in the top 10 movers today. Credo, don't even remember. I sold this one too early, okay? I'm going to get back in. But the bottom line is you like these, and you look like about a 3-year period or so, right?
Yeah, 3 to 5 years.
3 to 5 years.
According to 4 people with knowledge of procurement negotiations, Alibaba, ByteDance, and other Chinese tech companies are still interested in NVIDIA's AI chips, even if Beijing regulators aggressively discourage them from making such purchases. According to 2 people, they are keeping a close eye on NVIDIA's plans for a more potent chip, tentatively dubbed the B30A, and based on its Blackwell architecture, and they want assurance that their orders of the company's H20 model, which the U.S. company regained permission to sell in China in July, are being processed. According to those 2 individuals, the B30A is expected to cost around twice as much as the H20, which is currently sold for between $10,000 and $12,000. They noted that Chinese IT companies think the possible B30A cost, which was first reported by Reuters, is a decent deal. According to one, the B30A is expected to have up to 6 times the power of the H20. Both chips were created especially to meet U.S. export regulations and are degraded versions of devices that are marketed outside of China. All of the sources for this video declined to be named and were not authorized to speak to the media. One of the main grounds of contention in the U.S.-Sino competition for technological dominance is the degree to which China, which accounted for 13% of NVIDIA's sales in the most recent fiscal year, can obtain advanced AI chips. On the one hand, the United States has backed off from its earlier stance of imposing stricter limitations on NVIDIA's exports of cutting-edge chips to China. In order to prevent developers from entirely switching to products from competitors like Huawei, NVIDIA and other opponents of the regulations argue that it is preferable if Chinese companies keep using its processors, which are compatible with NVIDIA's software tools. Additionally, NVIDIA and U.S. President Donald Trump have an agreement whereby NVIDIA will donate 15% of its H20 income to the U.S. government. China is eager for its tech sector to transition away from American chips at the same time. According to reports last month, Chinese authorities have called in businesses, such as Tencent and ByteDance, on their purchases of the H20, requesting an explanation and voicing concerns about information threats. However, they have not received an order to stop buying NVIDIA goods. According to the 4 sources, despite this pressure, China's demand for NVIDIA chips is still high because domestic competitors like Huawei and Cambricon have limited supply. NVIDIA's chips outperform domestic ones, according to 3 additional sources who work in engineering operations at Chinese IT companies. When Reuters asked Alibaba, ByteDance, and Tencent for comment, they did not respond. Moreover, neither Huawei nor Cambricon answered Reuters' questions. When asked how it stands in comparison to its Chinese competitors, NVIDIA responded in a statement that the competition has undeniably arrived. It declined to comment further. The U.S. company released a weak quarterly sales projection in late August that did not account for possible revenue from the second-largest economy in the world due to uncertainty surrounding NVIDIA's prospects in China. Since then, the world's most valuable firm has suffered a 6% decline in its stock price. NVIDIA officials stated during its results call that, although the business has gotten certain export permits for H20, it had not yet started shipping because it was still resolving some concerns with the agreement to provide the U.S. government a share of its sales in China. According to two of the sources, NVIDIA CEO Jensen Huang has also reassured Chinese consumers that they need not worry about the H20's availability and has informed suppliers that demand is still high. According to a July Reuters story, NVIDIA has 700,000 H20 chips in stock and has requested that TSMC create more. Additionally, according to sources, NVIDIA plans to send B30A test samples to Chinese customers as early as September. According to Huang, if NVIDIA could provide competitive products, the Chinese market might be worth $50 billion. After an investor meeting with Toshiya Hari, the company's vice president of investor relations and strategic finance, JP Morgan stated that NVIDIA's supply chain is still under strain as demand for its AI processors continues to outpace supply. According to JP Morgan, demand is still more than supply, which keeps lead times long but steady. They also pointed out that these lead times are still measured in quarters rather than months, highlighting the robustness of AI expenditure more than 2 years into the current cycle. Despite industry rumors of delays, NVIDIA reaffirmed that its planned Vera Rubin platform is scheduled for a second-half 2026 debut. The company emphasized that rather than a buildup of outdated GB200 chips, NVIDIA's FQ2 inventory increase, which increased 33% quarter-over-quarter to $8.7 billion, was due to the Blackwell Ultra BW ramp. According to estimates, the great bulk of the completed goods have already delivered this quarter. According to reports, networking continues to be a growth driver, with attach rates in the upper 70s to 80% area. According to JP Morgan, management emphasized that NVIDIA offers clients choice in system design rather than combining networking and computing. Although no purchase orders have been placed, NVIDIA has been given permission by the U.S. government to export its H20 GPUs to China. If orders come in, NVIDIA's inventory may support $2 billion to $5 billion of H20 revenue in FQ3, which might indicate guidance of $56 billion to $59 billion, according to JP Morgan. JP Morgan predicts that rack production will increase in the second half of fiscal 2026 as a result of capacity expansion by supply chain partners and additional help from a ASP uplift from a mix shift towards BWU. Although NVIDIA's stock may appear pricey at first, context is important. The business is expanding far more quickly than its competitors, despite its enormous size. Sales growth should continue to be in the high double-digit range, while management anticipates a minor slowdown. By market capitalization, NVIDIA is the biggest company in the world and one of the most contentious. Can it continue to rise at its current pace? Is there too much excitement surrounding the artificial intelligence, AI market? Will there be competition? Is NVIDIA stock a good value? This is possibly one of the most talked about debate subjects. Let's examine why it might not cost as much as you believe. Let's start by addressing one point. NVIDIA's stock does merit a premium given its strong market position and remarkable growth. Therefore, there are valid reasons why it could appear pricey at first. But let's think about a few more things. The stock keeps rising despite its already high value since both sales and earnings are expanding at rapid rates. To put it another way, the stock may not be completely priced into its growth. Despite this, NVIDIA is currently trading at a high price-to-earnings (PE) ratio of 49, which is over double the average for the S&P P500. However, take into account its price-earnings-to-growth (PG) ratio, which compares its valuation to the rate of profits growth. You can see how NVIDIA's PEG ratio stacks up well against the other biggest players in the market, such as Microsoft, Apple, Amazon, Alphabet, and Meta platforms, below. Even though NVIDIA has a high price-to-sales (PS) ratio of 26, its revenue is increasing far more quickly than that of its competitors. Any appraisal must therefore be considered in its context. The market wasn't delighted with NVIDIA's forecast for sales growth of roughly 54% in the current quarter, and the company may be slowing down. That is still far more than its peers, though, which helps to explain the stock's premium. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Larry, job number, not good. Market, good. We're at session highs. More records across the board. Are you surprised?
I am a little bit surprised that the market continues to move higher. I mean, we just had a fantastic summer time period where we were up 12%. That was the third strongest summer that we've had in a long time. And I'm always of the belief that good news is good news and bad news is bad news. And right now, I do think that tomorrow, I wouldn't overstate tomorrow's importance because, as you just mentioned, I think a composite of all this economic data does point to the fact that the employment conditions are weakening, whether that's the Beige Book, the ISMs that have come out, the ADP, JOLTS, all of them are pointing to a weaker number tomorrow.
Yeah, the Beige Book, as we pointed out yesterday, higher number of references to tariffs and inflation than the previous Beige Book. The ADP number was weak. Probably tomorrow we'll see what happens. We got by the way, a new head of the BLS, and you don't want to go into the politics of it, Larry, but I'll venture to guess this, whichever way that number comes in, one side or the other of the political spectrum is going to discount it. How will the market react?
I think you bring up a good point because what's really been driving the market has been revisions. And I think tomorrow, when you look at those revisions, just think about this. If we have anything like we had last time, you're talking about the possibility that May and June numbers could actually go negative. And I think that that's one of the tail risk of tomorrow's numbers, that if you do see negative numbers, I think that could spring forward some of the rate cuts that the Fed could potentially be looking to do in the near term here. The other thing I'd mention is that, when we talk to our economists, the fact is that revisions are nothing unusual. Everybody points to the fact that these surveys are a lot lighter with the first tranche of responses that come in. And usually that's true. It's usually around 60%. But by the second or third response, it's usually up to like 90, 95%. And one of the reasons why we think that occurs, and one of our expectations, at least mine is that oftentimes if you're hiring somebody, you kind of report that, right? If you haven't really hired anybody, or if you've laid people off, you tend to be a little late to respond. And I think that's why you've seen some of these downward revisions here of late when you get the second and third revisions.
I think it's an excellent point, and it's an important point. Let me ask a different point. Does the jobs number even matter that much? I mean, I think it should, but with the changes at the top, all the revisions, the change in methodology, a lot of people not answering landline phones anymore, employers sort of delaying or not at all answering some of these questions, Larry, how much are you and your team actually even looking at the data?
Look, unless it's a tremendously outsized number tomorrow, and what I mean by that, the consensus is at 75,000, unless we get a blowout number of north of 150 or well below 50, I don't think it's going to be a market-moving event. I think the bigger story is going to be next week when we get the inflation numbers. Because if you look at the dual mandate, I think it's clear that the economy is slowing, particularly when it comes to employment. Next week, when we get those inflation numbers, from our economics view, we think that that's really the first sign you're really going to start to see these price increases starting to flow through to the data. And if that's the case, that'll just make the Fed's job a lot more challenging going forward.
What levels are you watching today?
Well, Sam, I agree with you when you're talking about that rotation. It's a little bit defensive this morning with utilities actually doing fairly well. You also have maybe some of these consumer staple companies actually doing pretty well. But if you're looking at the S&P 500, we have started off in the green, up about 0.1% so far here. And you have about 60%, 62% of the stocks in the S&P 500 in the green so far, which is exactly what you want to see. You guys just talked about that rotation trade. We are seeing information technology lag just a tad bit, but obviously we just started the market. From a level standpoint, the first area of resistance is 64.50. We're trading above that right now, around 70 points. That kind of coincides with that 200 period moving average on the 15-minute chart. And so let's see if we're able to actually leverage this now as an area that went from an area of resistance to an area of support and continuing to move higher. Your first major level on the call side here is 64.80 to the upside. Any breakdown, 64.20, you'd like to see some buyers kind of stepping in. You don't want to go anything really below that. 6,400, once again, could be a pretty decent area as well when you're looking at open interest. So overall, the technicals look okay. We are trying to recapture some of these losses here, and let's see how this kind of pans out when we get the ISM services data here in about 28 minutes. I think that's actually going to be a pivotal number that does come out, not just the headline number itself, but when you're looking at the prices component, which is actually still fairly elevated. And if we're still on the same trajectory to the upside here, you're talking about getting to levels that we've seen in November 2022, which kind of is a precursor to core inflation if you're looking at the CPI number, which may be a little bit of a headwind. But if we do see a pullback or a deceleration there, just like we saw ISM manufacturing data earlier this week, that actually could be a tailwind for equities. So I think that's going to be the big print for today that we'll be focusing on.
Yeah, it's a case of whether it confirms that trend or creates even more of a headache or a conundrum, certainly as far as the Fed is concerned with some of the mixed data. I'm just looking at the sectors this morning. We are seeing a bit of a pullback in technology, also materials under pressure, energy too, perhaps speaking to what we're seeing with these oil prices. What sectors are you paying attention to this morning? Because you have got utilities outperforming today and as well as some of the financial stocks.
Yeah, a couple of sectors just to keep on your radar here. We're kind of taking a little bit of a step back, looking at weekly charts. And the first one that we're looking at is the utility sector. This is going to be a 3-year weekly chart. Now, we have seen utilities do a phenomenal job this year, kind of breaking out of a consolidation range, hitting new all-time highs. But it has come back here a little bit. Now, this is the S&P 500 utility sector index, if you will. It's the similar type of trend if you're looking at the XLU, which is a popular ETF that everybody really looks at. And now we are seeing a pullback, coming back, testing that previous area of resistance, leveraging that as an area of support, and do we continue to kind of move higher here? I think the big question that we are seeing is that RSI is still making higher lows at this point, but MACD is kind of hinging here a little bit, just meaning that we are seeing a lack of momentum. But I think this is actually going to be very pivotal. If we do see this trend continue with the 10-year Treasury moving to the downside, breaking that 4.2% level, it makes dividend yields for utilities a little bit more attractive for the traditional ones, not looking so much towards the Oklos and the SMRs of the world, but looking at the Next Era Energy, the Duke Energy, things of that nature. So this has been an interesting trade, and it could actually be seeing a little bit of a tailwind here after this pullback, just given the macroeconomic environment as well as the yield curve itself kind of steepening